Welcome, everybody, to Coffee with FourThought. This is our August 2026 edition. Jake, great to have you here with us again.
Great to be here, Joel.
Welcome back. You were just on vacation for a couple weeks, so getting back into the saddle, jumping right into a nice little event here for our clients and folks listening in, so appreciate you joining us today.
Yeah, nothing's happened since I was gone the last 2 weeks, right?
That's good.
Okay,
yeah,
great.
makes this easy for us.
Yeah.
So a lot of topics we want to talk about today, so we're going to dive right into it. Go over our agenda real quick. Start off with our market commentary, just like we always do. What did we see in July, year-to-date updates, a quick little economic update like we always like to look at, what's going on with the numbers. Earnings season already off to a hot start, so we want to give folks an update on that. A couple of really big names that we want to highlight. And today I'm actually excited to finish off by talking about alternatives. What they are, how they work, how clients should be thinking about it, especially as they're entering or in retirement. So a lot of things to cover, so let's just dive right into it. So July, like you said, not a whole lot happening there, but it was actually a really, really volatile month. We saw a lot of ups and downs, especially in the tech sector. But tell us what we saw in the month.
Yeah, it was a bit of a rotation month. I think we saw some asset classes pull back a little bit. Bonds were down over 1%, which was interesting. But also real estate led the way, up almost 2.7%. And the stock market finished kind of down, but was just a really choppy month, I think. And as we look at some of the style boxes, we still saw value continue to outperform growth. And that was especially prevalent in small caps, where small cap value is actually positive by 0.73%. Small cap growth was down 7%. So that was a really big dispersion there, and one asset style box that I just thought was a little bit interesting there. And, small cap growth had done well. Small cap value, as we'll get into kind of how it's done this year, has continued to do well, but we did see a nice pullback there on the growth side.
Sure. Let's actually slow down around that because that's a good point. So we always like to talk about growth and value. We like talking about these style boxes, how the market's kind of broken up and the way that we look at it, large cap, small cap, growth, value. Large cap, small cap, fairly straightforward. Size of the company, you're a larger company, you're a large cap. If you're a smaller company, that kind of tends to move just depending on the size of the market, and these companies continue to grow. But value versus growth, kind of tell me the differences between those two so folks understand how we actually get to discerning the difference between the two. Is it a feeling? Is it something that we can look at and it's authoritative and there's function to it? Explain that to me a little bit.
Yeah, great question. It's definitely rules based.
Okay.
And the methodology that goes behind it is looking at value companies. We'll be looking at characteristics like price to book value, price to earnings ratio, like some of these valuation type metrics, and the companies that are described as having cheaper valuations get assigned to that value category. Whereas on the growth side, you're looking at revenue growth, earnings growth, even forward-looking projections. And this is done, the different indices have different providers, like Russell is one of the larger ones, or S&P is another one. And they define those characteristics, and companies can actually get a piece of each of those pies. For example, looking at large cap companies like Alphabet, they have some of their market cap assigned to the value index and some of their market cap assigned to the growth index because they have some of those characteristics. So it's not something that is you have to fall in one of those buckets or the other. You can have your value be a little bit piecemealed into both. But overall, it should give us an indication on how a basket of stocks trading at cheap valuations are doing and a basket of stocks that have more growth in their business are doing.
Got it. Okay, so that's a great segue. Let's go into year to date. So get a quick update on where we are year to date. International still looks like it's the outperformer. Emerging markets 20% year to date. You've got global stocks still beating. It's up 14% compared that to the bond market, which is virtually flat. U.S. still doing good. But again, I want to hone in on that value versus growth because something interesting happened at the end of June where the Russell reconstituted. So that just means they changed the mix. They took a look at those ratios that they like to look at for what's a value stock versus a growth stock, and they moved certain stocks in, certain stocks out. And I think when you look down at the bottom of the slide that we have up here, large cap value was up 16% year to date, and that compares to the growth side of the market that was 5%. But you and I have looked at this, and the 16% is a little bit misleading in my opinion, because when I think of large cap value, I'm thinking of Clorox, Procter and Gamble, GE, kind of the blue chip names that are growing, but they're not knocking the doors off of their earnings reports. But that's not what's actually in that 16%, is it?
Right. Yeah, that's a great point. Kind of like I mentioned, some of those names, Alphabet is one of them that is in the value index. And since it's such a large business, remember these indexes are market cap weighted, so it gets assigned to be a large position within that index. And there are other companies like it, like Meta would be another one that's in that index. We wouldn't think of these companies as your mature blue chip value dividend stocks necessarily. However, they have cheap valuations. Their price to book value is relatively cheap versus the other stocks within the index, price to earnings ratio. And it's funny because that can happen because of strong earnings growth. Let's say if you have a price that hasn't really moved a whole lot, Meta and Alphabet, they haven't done great this year necessarily, but their earnings have done extremely well. So at a price to earnings ratio, they're actually cheaper now than they were before. That could happen. So they're in that value index. They've actually had relatively good years, a lot of those companies, and that's led the value index to do better than the growth. If you look at what's pretty heavily in the growth index now, a lot of these semiconductor companies, which don't necessarily have that cheap price to earnings or price to book ratio, don't necessarily find themselves a lot in the value index, except for maybe like a Micron or a name like that. And so those stocks haven't done so well. And I think that's where we're seeing this juxtaposition really between the value and the growth index.
Yeah. So I'm glad you brought up Micron, because that was actually the big one that we saw. It was a part of the value because it was all valuation based. In June, they reconstituted it. It is now a growth name, so it had a huge run up until June. All the value indices got the benefit of that huge run up. Now it's in the growth side of the market, so if it starts coming down, it's not even in the value side anymore. So
one thing too that we've seen this before, and a lot of times it happens with small caps,
right?
Like the meme stock rally where AMC and GameStop went gangbusters, became mid or large cap companies, but that performance was still when they were in the small cap index.
Yep.
So the small cap index did great. A lot of those active small cap mutual funds that weren't really looking at the meme stocks at that time, that wasn't really their business, they underperformed substantially because, in a large part because of those companies that then found themselves in the large cap index and subsequently didn't do as well, So it's really interesting. And a lot of times, when you look at a snapshot that's 6 months or something like that, you have to try to separate some of that noise because that shouldn't be there in a full market cycle.
Exactly. You made my point for me, which is you gotta pan out. This is a function of how this is supposed to work. The system is working. The stocks are supposed to move between these style boxes over time. But it's always something to point out because of those short-term results that you can see, and we've been seeing this year. Now, before we move to talking about interest rates and the economy, I want to bring it closer to what we do for clients and what it looks like to be FourThought portfolio. So we have a strategy. It's called consistent growers, typically somewhere between 20 and 30 names, depending on the day. We're looking for those higher growth companies. If a company falls in the value category of large cap, does that mean it's not included in our large cap growth strategy?
No, not at all.
Okay.
We will not really take a lot of companies out of the top of our screen, and then they go through a series of tests. And for consistent growers, a lot of those tests are around the company's historical growth, if their margins are expanding, if they have a balance sheet that's of high quality. We're trying to look for companies that have demonstrated consistent growth, but also have the quality and the business capability to extend that growth in future years. And so we'll absolutely look for, companies that are value companies, growth companies, et cetera, even international businesses as well. Yeah. If they meet those screening metrics of consistent growth and also really strong business quality and competitive advantages, they can absolutely make their way into the portfolio. As you mentioned, we typically carry 25 to 35 names, so it's pretty tough to get in, and we want to have really some top conviction in the names that we own. And but to that extent, we'll see companies that are in the value index and growth index come into that portfolio. So when we look at these style boxes, it's not necessarily indicative of how our clients are doing because we have this custom approach to it. But it is interesting to see and to have the knowledge of what asset classes are starting to do well, what asset classes are starting to pull back, and take some of those pieces of information into our process.
So data point, not a decision point.
Exactly, 100%.
Okay, great. All right. So let's go over to interest rates, and we'll make this one a little bit quicker. Interest rates did tick up a little bit over the month. You can see them up there on the screen right now. Rather than going through the individual rates and kind of what we're seeing, I really want to talk about the Fed. So they came out, they had another meeting. This was the first meeting where we actually had some dissension around rate hikes.
Yeah.
So that was an official vote. I believe it was 7-3.
Yep.
8-3? 7-3. And so this was the first time that we're moving in that direction where folks are saying, okay, we want to hold rates steady for now, but we are seeing it move the other direction where we thought the rest of the year we might start seeing interest rate cuts. The data that we're about to review isn't showing that, and the FOMC is starting to look at it, and they're agreeing, and they're saying, no, we might actually be moving in the opposite direction at this point. Now, Warsh came out, no guidance. We expected that. He kind of hinted at that when he officially took over, said, this is my general stance. I'm not going to be coming out here and doing these big press conferences and telling you where we're going. We're going to get behind our closed doors. We're going to make our decision, and the market will know when everybody else knows. So it's a very interesting data point for the rest of the year. We're moving in a different direction. For me, I think rate cuts are completely off the table for the rest of the year. Hopefully we remain steady. But again, we're about to go over some of the economic data here, but we might actually be moving back towards a rate hike.
Yeah, I agree with everything you said. One thing to kind of opine on, because I think it is so interesting, is with this new Fed chairman, we are going to get a major difference in the Fed's communication to the market and to the overall public. In fact, there are 5 task force that Warsh put together. One of the 5 task force is about change in the Fed's communication. And as you alluded to, no guidance. Warsh also didn't put his dot on the dot plot for where he expects interest rates to be over the next year. So just a lot of differences that we're going to have to adjust to, that analysts are going to have to adjust to as well. And we'll see where that takes us. I would agree. I don't think that there's really a path to having a rate cut happen this year. Now, things can obviously change, but that's kind of where we're at now. I think the one thing to look at with these key interest rates, and we talked about it last month, was in the lower quality segment. So that'd be U.S. corporate CCC. And that right now is at above 14%, 14.3 about. It increased over the last month by about 30 basis points, 40 basis points. But if we go a year ago, that was at about 12.3%. So over a 200 basis point jump there. And again, we talked about last month, those are on kind of the least desirable companies on a credit quality or balance sheet perspective.
They're struggling.
They are, yeah. And, that's going to hurt them. And that might have a ripple effect into the rest of the public market and maybe even the private markets as well.
I think it's a great point because we did see this also back. Typically, corporate debt is shorter term debt. Sometimes it's longer term, but a lot of times it's shorter term. And these companies are looking to refinance. So when a bond comes due, they're looking to go back to the credit markets and they want to get more money, and they're going to continue to pay those interest rates. So if you're a company that last year you were borrowing at 12% and now you're at 14%, that's a significant impact to your cash flow, your balance sheet, all those other things. So it's definitely something we're keeping an eye on, especially in those private markets. These tend to be smaller companies. They're less financially stable, so you expect that higher return. But what the market's telling you right now is those smaller companies that were in hot water, it's starting to look a little bit worse as kind of these economic indicators and things are coming out.
And I think the one thing with that is if these companies continue to grow, maybe not a problem.
Sure.
But if they're not able to grow, then it might become a little bit hairy.
Yeah.
And we might see some credit events or some defaults, which we just haven't really seen over the last 5 or so years.
Yeah, so that 14 can turn to 0 real quick.
Yeah, exactly. But yeah, let's get into the key economic data here. We've got our scorecard. We've got kind of the 3 top, I think, factors on the top of the page. I think all eyes right now are still on inflation. CPI still sticky, 3.2% over the last year. Interestingly, a lot of that pressure has been because of oil markets or energy markets. Oil has come down a good bit, but still up over 30% over the last year.
Yeah.
So that's still having a pretty large effect on overall inflation, but also core inflation, where you strip out energy and food, some of those more volatile items, that's still above kind of the target. So, we're still not seeing inflation come down to a level where we could get some ease in interest rates.
Yeah.
And again, why, they haven't continued to lower rates, and why some are saying we need to hike rates because get this inflation tamed.
Yeah.
What else have you seen? Yeah.
And I think they have tamed it to a certain extent. We've moved down from we had double-digit inflation just a few years ago. It's been tapering down. It's been holding steady at the 3% rate, which is good to see. What you don't want is inflation volatility.
Right.
You don't want to see it jump from 3 up to 5, back down to 2. They do have their long-term target, but I think they're kind of starting to throw their hands up and saying we're probably not going to be able to get there with the tools that we have. There's just too many things outside of our control. So as long as we can keep it steady, that's our goalpost. But they still have plenty of dry powder in the tank with the interest rate hikes that if you see it continue to increase or stay higher than where they think they can keep it, they can use that as a battering ram to try to get the inflation back down. But so far it really hasn't, like I said, it hasn't moved. We've been steady, which is actually kind of a good thing.
Yeah.
My grocery bill, not so much, right? But so the other thing that I was looking at was the oil prices. So it's down 20% over 3 months. Of course, a lot of that is to do with what's happening over in the Gulf. Still doesn't look like there's any sort of end to this, but the market is, I don't want to say new normal, but they've ingested the uncertainty of it. It seems that if it's going to move in a direction, it's going to be in a positive direction for the markets. And so you've seen oil come back to about $84 a barrel. That's good news for the overall markets. That's a sustainable price. Anything above 100 is really a negative for the overall economy. So I think we're in a better place with that. The real big one for me is the retail and the auto. So with cooling, so let's back out real quick. With AI and all of these things that we've been talking about with the labor markets, we haven't seen it.
Yeah.
Now, it is a little bit of a participation story, people leaving the labor markets, but labor's actually come down to 4.2-ish%, so it's been holding steady at just above 4. That's good news, in my opinion. I think that's a good steady rate of unemployment. That leads to better consumer outcomes. We're a consumer-driven economy, so we haven't seen the spike that everybody was expecting. Now, certain sectors you have, and of course we feel sorry for those folks. But overall, again, the economy's holding up. The consumer's doing just fine when you look at them as a group.
Right. Agree with you there. And again, it's kind of another case of you don't want to see a bunch of volatility in those numbers either. You could really get bogged down on the jobs reports that come out.
Yeah.
But man, it's once you dig into those numbers and see how the sausage is made, nobody wants to eat it. And it's kind of one of those things. It's do we really put a whole lot into those numbers? Not really. I mean, I think that the story is there of unemployment pretty much being steady, which again we like to see. There's not a whole lot of job openings that are coming available, but there's not a whole lot of layoffs either at this point. So to me that is sort of like a neutral stance.
Holding pattern.
Yeah, holding pattern. And we've had positive GDP growth, real GDP over 2%. That's a solid growth on a real basis too. To your point about retail sales, they've held up. The consumer is still spending. I don't really think in general the consumer is pulling back in a whole lot of areas. I I took a couple flights over the last week on my vacation, and those flights were full, So just a little anecdotal nugget there. But yeah, I don't think a lot of these are really that frightening. We pointed out loan delinquencies as an item that we saw starting to rise, but over the last 3 months, that's held flat and even come down a couple basis points. So not really a factor that we would put a red flag on either. And so that's where we're kind of at. We're getting into earnings season, which we'll talk about. The corporate earnings have done really well as a little bit of a hint there, but overall the economy, I don't think anything sticks out as super great or super terrible either.
Yeah. Well, you mentioned earnings, so let's go ahead and switch over to it. This is where you and I really get a nerd out and we get to look at what these companies are doing. So each quarter, it's a regular cadence, and we're already well into earnings season. Had some really big names that we'll dive into, but give us the first overview on what we've seen thus far with the earnings that these companies are telling us that they're getting.
Yeah, sure. So about 60% of S&P 500 companies have reported at this point, and we've seen the vast majority of them beat expectations. In fact, it's been just shy of 90%. And if you go down various sectors, you can see which ones have beat at a higher than average rate and what's kind of been lagging a little bit. I'll talk on the not so great part at first. We've seen a beat rate of 68% within real estate. That's been the lowest on a percentage basis. Still not bad, right? But compared to an 87% average, you can see that's a sector that's held back a little bit. And same on the consumer side, both staples and consumer discretionary, both around the low 70% range. On the high end, we have healthcare at 97% has beat, 29 beat, and just 1 missed their expectations. Technology and financials have both been about 90%. As we go to the next slide, too, I think looking at it from a graphical standpoint, you'll see about 55 industrials and financial companies have beat expectations. Now, they have almost fully reported. A lot of the banks kind of get it out of the way to kick off earnings season. So we've seen most of those results come in already, have a pretty good idea of what that sector is going to look like. And some of the others, haven't quite caught up yet, but we'll see those over the next couple weeks. But yeah, a 10% average surprise to the upside on earnings. And if we look at the factor of companies that have beat versus those who have missed, about 6.5 times the amount of companies beat expectations versus those who missed their expectations. So looking at this sample here, we see a really strong growing, not only economy, but companies that are leading our nation.
Now, when you say beat or miss, are you talking about the company's expectations, or are we talking about analyst expectations for that company's report?
Great question. So these would be based on management's commentary and their expectations. Analysts might have different expectations, and that's where you can see a company that beat their expectations, maybe even they raised their guidance, but Wall Street didn't think that was quite good enough.
Sure.
So they might have missed the analyst expectations, but their own corporate management guidance was beat over that quarter.
Because when I look down this list, the ones that you pointed out, so the consumers, the discretionaries, the real estate, those to me feel much more predictable. Yeah. Now they will have some variation in there, of course, but they are a little bit more predictable. And then you've got the tech and the healthcare where it's much more volatile. And so maybe they're sandbagging a little bit.
Yeah. I think when times are good, management has the tendency to want to sandbag so that when, things don't go their way or maybe they don't make a contract or two, they've got some buffer space so that they can still beat. Yeah.
Right.
And each management team is a little bit different too. There are some who, and you got to look at conflicts of interest, are they looking to raise capital in the next quarter? These are things that might bias how management is communicating to analysts. And so that's why you have to kind of pay attention to both, because you might pick up something that hey, all the analysts are expecting this company to have a lot more in earnings than the company themselves is projecting.
Right.
What's going on there? Let's take a look under the hood there and see. It might be something that is just completely unrelated, or maybe the analysts are just wrong and they had too high of expectations. But yeah, great question to bring up there.
So let's dive into two of the companies that we follow as a firm, companies that pretty much everybody's going to know, but we'll dive into them a little bit. And let's kick it off with Amazon here. So Amazon came out, Q2 26 reports. I would call it a blockbuster, especially on the AWS side of things, but tell us what we saw from Amazon.
Well, and it's funny now because AWS is like the majority of their operating income or profits at this point. So when you think of Amazon,
AWS being Amazon Web Services. Sorry, yes. Jargon.
No, that's okay. Yeah, their cloud service. When anybody you ask anybody on the street, what does Amazon do? They will undoubtedly tell you, oh, I can go buy something and it will show up at my house the next day, right? That's not what we're talking about here with AWS, which is the majority of their business now, being a cloud providing service. And that really is where we saw the most amount of growth, and really where Amazon kind of gets their valuation from is on how well they're able to capitalize on AWS. And we saw really great growth. It grew 37% year over year, which is immense because the revenue that AWS brings in is over $40 billion.
Right. So
to grow at 40% on that large of a revenue amount is, you can't even comprehend it really. But that's also been their fastest pace in 18 quarters, which is just so interesting. You go through the last, the last 4 or 5 years, and we saw the emergence of cloud just continue to become more and more adopted. And so for that to be its quickest pace over the last 18 quarters is phenomenal. It's also their 5th straight quarter of an acceleration in growth too. So again, when we look at like consistent growers, Amazon, is a lot of times kind of the poster company that we'll look at in some respects, and they're able to continue this growth while also expanding its margin as well. So there's just great economies of scale within Amazon and AWS in particular. The margin expanded by 650 basis points to just under 40%. So it's a profitability cash cow for them at this point. The backlog grew to $496 billion, which I had to make sure that I didn't see a decimal point in there at some point because that is immense. Some of the large adopters are actually Anthropic, OpenAI, some of these large language model companies. So you're seeing really good tandem in Amazon and the AI growth story, which is great. So all this happened, they continue to expand their capital expenditures, which the market doesn't love. You look at Microsoft and Meta and another company that we'll get to in a minute here, but the market's penalized that spending on growth, spending now for growth later. But Amazon's at the crossroads of they're spending now, but they're growing now as well. And the proof is in the pudding. You see that. The stock was up about 13% after hours there in the next trading day. So certainly a great result for Amazon. It's tough to really poke a lot of holes there.
Now, when you do look at their earnings, the important thing, you brought up AI, which is a big part of their story, especially in the AWS space. They're coming out as trying to be the secure cloud provider for AI, basically. So it's good to see. They did, this is just fun accounting that you can do between sales and earnings. They did have a position in Anthropic, which a lot of these companies are starting to do now, where they're taking positions in these up-and-coming AI, whatever it is. So they did have an adjustment to earnings that you had to back out, but they still beat handily, even with that adjustment to the write-up in the Anthropic value that they had. So blockbuster report, fantastic to see. And then we move over to talk about Alphabet, the parent company of Google.
Yep.
And still a good report.
It was, yeah. I think first off, you mentioned like the as reported earnings per share versus the adjusted earnings per share, backing out some of those like core business related or the unrealized gain within Anthropic. Google had that as well, but they also had SpaceX. So they had a realized gain in SpaceX, and as a result, their reported earnings per share was a lot higher than their adjusted. And actually, if you look at their adjusted, they were one of the companies who missed the expectation. So, one of those few, one of the 10%, or so. You want to say
so when you actually look at that revenue line, we have it broken out there. You have other bets. They've been doing this for years. For the longest time, their biggest other bet was Waymo.
Yep.
They had, believe it or not, Fitbit was in there a long time ago. So this has just kind of always been one of their practices of evolving as a company. And this has been the most notable increase to their bottom line with these most recent IPOs and valuations in these private companies that they took stakes in.
Right. If you look at the breakdown, it is a very small part of their overall business. But to your point, it happened to come all at one quarter. So yeah, that's where you saw that. But still, like if you look at their results, a lot of the same tailwinds that we saw with Amazon coming from cloud were apparent with Alphabet as well. They had 82% cloud growth. The margin expanded as well. Actually, it almost doubled to about 34%. So you start to pick straws here of like, yes, it's not quite as large as AWS. Yes, it's not quite as profitable, but still relatively the same there. I think Google just has a whole lot else going on too. And that's where some of the muddiness starts to get brought in, especially around Google services like search. You know, like is some of that going to be cannibalized? There's not a whole lot about Amazon. It's pretty lean between kind of their mercantile business and then cloud. And that's kind of it. Mm-hmm. And, you know, AI isn't really a threat to their merchant business. If anything, it probably benefits it.
Right.
Whereas Google has kind of another business line that could be a threat from AI. So that's where you start to see a little bit of that. But they also expanded their CapEx guidance, so moved it up. And that's where I think the market really penalized them. Shares were down about 5% after hours. I just think it's interesting. We look at kind of the big five in CapEx spenders, so like these cloud providers, Meta, Microsoft, also included in there. They're expected to spend about $725 billion in CapEx this year, and that's up 77% from 2025. And we talked about it in 2025 as being like, wow, this is really incredibly high in the amount that they're going to spend. And that's almost doubled now into this year. And again, the market is kind of slamming the table at this point saying, where is the profitability from this?
Exactly.
Like, you know, these bets that you're taking, when are they going to pay off? You're seeing, you know, Amazon, it's already started to pay off. And the market's rewarding them for that, you know, whereas Google, it's a little bit less clear and they got penalized for it.
And we're not highlighting them here, but you also saw the same thing in Meta. So it's a great point to bring up, which is you're spending all this money. You're telling us you're going to continue to spend this money. We're fine with that as long as you're showing us the results. And if you're not showing us the results, we will punish you, is basically what they're saying. Now, Alphabet was in an interesting position because when all of this was coming out, they were kind of the fall behind in AI. Folks were starting to think that maybe they were not going to be able to keep up. They've changed that story. You saw that in the stock price recently. And then they came out with the earnings and kind of went back the other direction. So it's a company that we've been following for a long time. We're going to continue to follow them. And if the story continues to be we're spending without return, not a great story. But if you can start showing results, and this goes for any AI company, we need to see results. You can do the spending, but we need to see results. Not to harp on Meta, but same thing. You saw them when they came out with the metaverse, and he was going to spend however many $1 billion on that. The stock was punished to oblivion because there was no return on that. But then they said, hey, sorry about that. We changed our mind. We're going the other direction. Okay, we like you again. So the market can be finicky, but this is really where fundamentals come in, where you have to look at what the companies are saying. You have to go through these earnings reports, and you have to understand what you're buying and where these companies are going without just kind of going with the story. You got to understand the story before putting money into it.
Agree with you.
Okay, good.
Let's move into something a lot of fun, and that is very, very topical. Has been over the last 3, 4, 5 years now, and that's alternative investments. And, you know, what we want to talk about here is just kind of the nitty gritty, because we could spend, you know, a whole 45-minute, an hour, even multiple segments going into the very minor details of all the different asset classes, everything that goes into it, all the different structures. I want to keep this a little bit high level, but kind of talk about the differences between the two major fund structures, and then also whether or not it really even makes sense within a client's portfolio or not, and what are the sort of the items to pay attention to on what either makes that a yes or no, and also what percentage then of the portfolio should be invested into these types of businesses. So you want to start us off, Joel?
Yeah, let me try. So let's start with the fund structure. So the two most popular that I think people are going to see, it runs the gamut. You can do this a couple different ways, but right now it's been interval funds and it's been drawdown funds. So when we say interval fund, what we mean is that they can take in money anytime. Mm-hmm. You can make a commitment to them. You send the manager capital. But what they do is they don't allow you to get that money back out until certain periods throughout the year. Typically, it's quarterly. So that's why we call it interval. You can't liquidate it just like a regular stock. You have to wait. That also comes with some underlying structures to it. We call it gating.
Yep.
That withdrawal right. So you and I, if we're 100% of that fund, you and I can't go to that manager and say we want all our money back. They have the right to say, no, we're going to cap you at a certain percentage of that fund. There's some structural reasons behind that. That's one of the gotchas right off the front to be aware of. But that's why we call it an interval fund. You put money in whenever you want. You can only get it out every now and then. You can also use the term semi-liquid. I personally don't love that term. I think it's just illiquid, but that's one of the things you'll hear. Then you move over to drawdown funds. Mm-hmm. This is your typical private equity, your hedge fund, where a lot of people got familiar with like the 2 and 20 structures. A lot of jargon going on there, but this is what we're talking about. What the drawdown fund is you make a commitment to that manager. Mm-hmm. That manager is going to go out and look for investments, and they pull your capital down over time. They draw it down over a period of couple of years.
As they find investments to put the money towards.
Exactly. Yep. So it's not all at once. Mm-hmm. They want to wait because that's also how they're compensated, is the return that they're getting on those dollars that you're giving them. So it's a period of, it can range between 2 and 5 years typically, mm-hmm. but then these are also much longer term investments. So these are truly illiquid. Very typically you'll see investment periods and return periods of about 10 to 12 years.
Yep.
So much longer time frame there. But anything you would add, anything I missed on the general structure of those two?
No, it's great. So with the interval fund structure, your money kind of goes in right away into a pool of investments, and there's no real end date to it. However, you can get in queue to try to withdraw your money on typically a quarterly basis.
Yeah.
To your point, you might not be able to get it all out in any given quarter. It depends on what other investors in the fund are doing there too. Whereas a drawdown structure, it's a closed-end vehicle. Like there's a start date. The manager, as they find investments, will start to pull your capital in. Mm-hmm. And then there is some end date where the manager will distribute the capital to you. You don't have to queue up in line. In fact, you really can't really get your money out until the manager gives it back to you.
Right.
Typically, that's a 10 to 12 year, depending on the different asset classes. But private equity, most typical 10 to 12 year period there. So yeah, I think that's great there. We talked about the capital, the liquidity, the valuations. I think is interesting. With the evergreen funds or the interval funds, they will have some sort of auditor that goes in and will appraise and assign a net asset value of the fund. That's important because every quarter they need to assign some value that your shares are worth,
right,
to be able to give some withdrawals. Whereas in the drawdown structure, these are kind of periodic appraisals. Oftentimes they come with a lag. It's a lot of like internal methodologies that get that happen there. Like if a similar company had an IPO, they can use that valuation to assign to that company. But it doesn't really matter because you're not able to actually redeem any shares until that manager actually has an exit on that company. Mm-hmm. So, throughout that term, the valuation is a little bit more opaque, but also it doesn't really matter because the only thing that kind of matters is the end,
the exits.
The exits there.
Yeah. Mm-hmm. So the reason we thought this was timely, that I wanted to make sure you and I had this conversation, is because there's two really big things happening in the market right now that are exactly this. The first being private credit, where you're starting to see the headlines that these funds are being gated. Mm-hmm. That means that folks are trying to go in there. You're seeing things like 10 to 13% of the NAV being requested. Those are getting capped at 5%. That's part of the structure that you need to understand. And we'll get to the gotchas in a second and the things that we look out for and then position sizing. But the other one, and the reason I think this is good, is you see this happen in cycles. you get some really high profile IPOs like Anthropic, like SpaceX, all of these ones that we've been hearing about. Typically, these are in the drawdown fund structure.
Yep.
We're not saying they're bad. We just want to make sure you're going in eyes wide open into what you're getting into. And what I anticipate we're going to see is basically road shows with a bunch of people coming out saying, we're going to be the next great thing. Look at what Anthropic did. Look at what SpaceX did. This is why you should give us money. And managers will start to raise off of this. Mm-hmm. Again, nothing necessarily wrong with that. There's good managers. There's bad managers. We do the due diligence on that for our clients. But you just have to be aware that this is going to be happening because they're going to be using that as basically marketing material to start raising funds moving forward.
Right. I mean, there's so much we could go off of. One thing I do want to say is that in the interval funds, the gating of the fund, that's not a bad thing. Like,
it's part of the structure. It's designed to do it, right?
Yeah, and the reason is to protect the other investors in the fund. And one thing we have to remember is, it reminds me of like the Silicon Valley Bank issue where there is a mismatch in their assets and their liabilities.
Yeah.
The bank took in, deposits, which are liabilities to the bank that they might have to pay back when they come due. When somebody comes to the bank and says, hey, I want my money back. Those can be short-term in nature. And they went out and bought long-term treasuries, which are longer-term in nature. And with these funds, you kind of have the same imbalance where you have liabilities that can be short-term in nature if investors try to get out of the fund on a quarterly basis, and they're taking positions in illiquid private market securities that have a longer maturity date, right? And so a couple things that they do to help with that is they have some sort of liquidity pool. And so that will be a reserve that they keep to the side. Maybe it's 10, maybe it's 15%. That's going to be either held in cash or they're going to be held in liquid securities, something that, when
relatively risk-free, they can get to it quick.
Exactly.
Yeah, okay.
But what that can do is it can water down and dilute the returns, especially if you consider this vehicle to be like a private equity fund on the interval side. It's like, well, we have to have some sort of premium above public markets, but if we have a 15% of your capital needs to be short-term risk-free securities, how can you really do that? It becomes a lot more difficult.
Yeah.
So that's one thing. The other thing that is important to talk about is the taxation of the vehicles themselves. A lot of times the interval funds will go off of a 1099, a lot smoother from a tax reporting standpoint. And the drawdowns typically have a K1. So a lot of times you have to maybe delay filing, a little bit more hoops to jump through.
Yeah.
So that can be a consideration as well. The thing that is so important to think about is you go to these alternatives to do one of a couple things. You might look to diversify your portfolio, get some exposure that's not just public stocks and bonds. Or you might look to have a return enhancement security, like a private equity, something that we think will just do better than public markets. And the third would be a diversified income stream, right? So something that is coming in, maybe is yielding a little bit better than bonds. But all of these have trade-offs. And when you talk about like managers coming out and starting to do roadshows now because of how well some of these private equity investments have done, we saw this 4 years ago or 5 years ago with the rise of private credit managers coming out of everywhere, first-time funds and all this. And the thing to remember is that the return dispersion between the top quartile managers and the bottom quartile managers in alternatives is extremely wide. And versus public markets, it's very, very narrow.
Right.
So if you're in, public, let's say a large cap manager, the best manager and the worst manager, there's some difference, obviously, but it's not going to like make or break, what's going on. Whereas in alternatives, that, return could be, the top quartile above 20% and the bottom quartile could be negative, So that's really important that you align yourself with a manager that knows what they're doing and is able to, hopefully be in that top quartile. What we found is that if you're kind of the median in any given category, you're not really like adding any value over a public exposure, especially for all the additional complexity, paperwork, taxation, gating, all these other things to consider. So there can be some pros to it, especially when you think about diversification, maybe getting a different income stream or inflation protection. There are pockets where it can work, but man, you have to be really careful about the manager that you're working with, and also if the fund structure is really helping you meet that need that you have.
And is it aligned with your overall goals? Because at the end of the day, so this is a good move into, let's start talking about positioning, how we think about it for our clients. And what I always worry about is that folks think that they need to have alternatives. Mm-hmm. They need to have some of this in their portfolio to meet their long-term objectives. And just frankly, they don't. Mm-hmm. There is no need to have these. But to your point, if we're looking to do something diverse, if you want to get some flavor of market that isn't public equity, if you're trying to improve your overall income stream, if you're trying to enhance returns, whatever that goal is of this position that we're putting inside of your portfolio, if this structure meets that goal, then we'll go ahead and move forward with it. We do all the manager due diligence, and we make sure that we're getting in with the good managers. But at the end of the day, this isn't a default. Right. This is not something that fits every investor. There's complexity to each of these. There's position sizing. So we're talking about aligning time horizon with what these funds are going to do. There's a lot that goes in behind the scenes to getting that positioning question right for certain clients that just is not as easy as putting it into a model for most people and saying that we're good to go, right? I mean, you can get into liquidity crunches. You can misalign investments with your investor risk tolerance. I mean, there's so many things that can go wrong. This is a corner that we slow down with our clients around to make sure that we position each client's portfolio with their goals and objectives, and then we find investments that match those goals and objectives.
No, I couldn't have said it better myself. And if we take a step back too and look at these investments that it's kind of like FOMO, right? Everyone's like, I gotta have it, my neighbor has it, and all this stuff.
I could have had SpaceX.
Yeah. Exactly. But if we look at it, like this asset class going back even 10 years ago just wasn't even really available to the private markets. A lot of it was through endowments or pension plans and insurance companies. Like that was where a lot of these investments were being marketed to. Mm-hmm. But now, because of kind of the rise in private wealth and private market clients, that's kind of been their new pool to bring in capital. And what worries me a lot, especially on kind of the interval fund side of things, is these managers are so huge, or they could be emerging managers who are trying to just get their start. In either case, they're managers that are kind of hungry for capital.
Yeah.
Like they kind of need to bring in capital to keep this thing going kind of thing. And that worries me a little bit because if you look at the best of the best managers within these spaces, a lot of times they are almost impossible to get access to because they've kept it small intentionally to say, hey, if we grow any larger, we're not going to be able to keep being a top quartile managers because our return streams will go lower because we'll have to go to our second or third top conviction idea instead of just sticking with our first or second top conviction idea. So, all of that
it's their version of economies of scale, right? It's a law of large numbers kind of idea. Percentage wise, it gets tough at bigger firms. Yeah,
exactly. Yeah. And so when you compound that with having to have a liquidity bucket as well, and you have management. A lot of times we didn't touch on the fees a whole lot here, but a lot of times in the interval funds, the biggest chunk of the fee is going to be the management fee, which they get whether they do really well or really poorly. Whereas in the drawdown structure, they still have a management fee, but they also have a lot more of carried interest, which is basically their incentive fees. Like they're more aligned, and the better they do, kind of for the investors, the more fee that they can get.
Yeah.
A lot of times that carried interest is way more than even the management
That's
fee.
what they're aiming for.
Exactly. So, those different dynamics and fees can also have an implication as well. So again, not that we are saying we hate them, we love them. Each of them can have their place within a portfolio, but to your point, it's not our default. Like we're going to have our default be stocks and bonds. These things that we've known, we have, history with, and we can sort of know how they do. These are sort of separate from that, and we can use them as more like investment solutions when the need and the goal arises, and they can be a good fit in the certain situation.
Couldn't think of a better place to stop it for today. So, Jake, thank you very much. Folks, thank you for joining us today, and we'll be back here with you next month to do this all over again. Thanks so much.
All right, take care.